also about kind of the politicians and the stimulus response?
Yeah, look, I don't like the Fed, full stop. Let's just be clear, right? They call it the creature from Jekyll Island for a reason. I think the Fed has one job, and that's to enrich bankers, and that's always been the job, right? The Fed was created by John D. Rockefeller's father-in-law, who was the most powerful senator in the world back in 1910, and John D. Rockefeller, Titan, and J.P. Morgan were good buddies, and they didn't like the competition from these trust companies that were coming up in the banking system, and so they had this plan to create a lender of last resort to support the banks and make sure they'd never have a bank crisis again and runs on the bank. Although I'm sure everybody saw the video of the head of the FDIC saying, please don't take your money out of the bank, else there'll be a bank run. Could you trigger a bank run any better way than saying that on live television? Crazy. And now it's gone viral on the internet, makes it even worse. But the Fed, their response is always predictable. The Fed has one job, and that's to enrich bankers. So they don't care about the little guy. They don't care about corporations. They care about banks. And so think about it. Fed funds, who borrows at Fed funds? Do you borrow at Fed funds? Do I borrow at Fed funds? No. Banks borrow at Fed funds. And what do banks do? They borrow at Fed funds. They buy treasuries because no one else will buy treasuries, because who would buy bonds of an over-indebted country that's issuing trillions of dollars of deficit every year? No one. So there has to be someone to buy it. So the Fed has bought all they can through QE. So they lend money to the banks, and the banks buy them. That's actually a riskless trade. Right? JP Morgan last year had 0 negative trading days. That's impossible if you're actually trading, right? No one's that good. But if you borrow and invest in a riskless trade, that's a pretty good deal. And you lever it up 11, 12 times, you're good. So the Fed, since 2009, reliquefied the banks. Now, despite reliquefying the bank stocks are still falling. Why are they still falling? Well, because people have realized in zero interest rate world, or worse, negative interest rate world, the banking system breaks down. And you look at Japanese banks for the last 20 years, they've gone down. European banks for the last 16 years gone down. US banks are going to keep going down. And there's lots of reasons why that's going to happen. So the Fed's doing their job. They're trying to protect the banks and non-bank financial institutions, Citadel, Millennium, Bridgewater, all these other non-bank financial institutions that are now too big to fail. So I'll say the Fed's doing what the Fed has to do. Full stop, I don't like it. I don't think it's that effective. And I think the market last Monday was proof, right? The Fed says we're going to lower interest rates all the way to 0 overnight, Sunday, emergency, after the emergency 50 basis point rate cut the week before. And the market still went down 10% that morning, or 9% that morning. So I think people realize that the Fed has lost credibility. I call it, hashtag Fed in a box. They have no choice but to do what they're doing. And they're going to print as much money as necessary to keep the system liquid. But therein lies the problem. We don't have a liquidity crisis. We have a solvency crisis, or a potential solvency crisis. And just like in 2009, liquidity can't solve a solvency crisis. And the problem is we need a raft of bankruptcies to occur and cleanse the bad companies. So that's where the fiscal comes in. So now, as of this afternoon, I guess, we're going to have this giant save bailout plan where we're going to hand money to malfeasant CEOs and corporations who have frittered away their competitive advantage by not investing in R&D, not investing in people, not investing in property, plant, equipment, not saving for a rainy day, levering up and buying back their stock because they needed to feed the beast of QE. Now, what do I mean by that? Well, the Fed is not allowed by law to buy stocks. Well, the only buyers of stocks over the last 3 or 4 years have been buybacks. Why? Well, because the boomers, myself and all my brethren and sisterin, right, 10,000 of us turn 65 every day. I still got 8 years to go. But every day, 10,000 of us turn 65. And another 10,000 of us turn 71 and a half. And at 71 and a half, you have to withdraw from your retirement. And so $1 trillion has to come out over the next 17 years. Each year, that's 17 trillion with a T, has to come out of stocks. some bonds, but mostly stocks, out of 401k plans and retirement plans. So that was a negative drag. It also turns out that 65 to 85-year-old people don't like stocks, they like bonds. And other than Mario Gabelli, who took the picture of him buying green bananas yesterday on Twitter, legend, by the way, Mario's awesome. Most people don't really want to plan for the future. They want the now. They want to have money now. So there's demand for stocks went down other than buybacks. Well, why did buybacks go up? Well, the Fed, unlike the Bank of Japan or the Swiss National Bank, which are allowed to buy stocks, isn't allowed to buy stocks. So what they did is they cut a deal. They called all the corporate chieftains, and Buffett, anything that Buffett owned was now suddenly going to be given a massive tax cut. In exchange, you can't do R&D, you can't buy new facilities, you can't hire more people, you have to buy back your stock. And so Apple, my favorite one to pick on, has the same profits as 2015, yet their earnings per share, quote unquote, air quotes, is up 20% because they retired a bunch of shares. Well, who bought Apple 5 years ago? Oh, Warren Buffett, but he said he hates tech stocks. Well, they're not a tech stock anymore. They're a mature business that is milking a cash cow and buying back their stock to fabricate artificial earnings growth. So you have that happening all over. I call it stealth QE. That now stops because prices are falling. So now you got the last buyer of stocks gone. Companies are flailing, and they're saying, well, now you got to help me, government. So what does the government do? Whoever paid the most into lobbying is getting the biggest check. And I thought the great calculation someone put out there is, if you just divided the total number by the total number of people in the US, excluded babies and just talked about adults, it's about 58,000 per household. We're getting checks for $1,200 each plus $500 for our kids, 3.14 people, that's about $2,900. Where's that difference from 58,000 and 2,900 going? Oh, Wall Street executives, hedge fund managers, and people like BlackRock who are going to get to manage these big funds that are created. Call me cynical, but I think that sucks.